Hello everybody and welcome back. Well, many of us understand the idea of supply and demand. Of course, 2022 has been shaped by it. Inflation, potentially out of control, and a big reading is coming. If we have a huge amount of demand and obviously we have a low supply, things happen such as inflation. But now we come into another area of interest in the markets, and that is an area of potential demand, a defended zone by the street. Will they defend the 50% retracement of the Nasdaq off the 2020 lows? Let's talk about that and more with all markets discussed right now. See you soon. There's a lot to talk about. So welcome back everyone to the channel. This is our daily recap for the stock, commodity and crypto markets around the world for the close 10th of May 2022. And as you can see here, the fear and greed index is still reading extreme fear. Now, sometimes people say fortune favors the brave. Will that be the story of the next week? Well, there are some stats that point to that possibly being true. And that doesn't mean we're through the eye of the worst market yet, and we might not go lower, but there are certain things that point towards a rebound will come at some point in the next little bit of capitulation around here. Apple, Nvidia, semiconductors growth, they were the best sectors for the last 24 hours. We can really see that represented by this chart. And something that I want to show you a little bit later, we did in our private stream, which you can join if you're interested in, 7-day free trial, link down in the description below. But basically we spoke about the SP 500 hitting a level of supply. It did early in the session, and then of course all markets sold off. Remember, this is the retail hour of power, and this usually is where the trapping occurs of us, the retail traders. Then we move over to the close, and there was a little bit of a rally after the lunch session, and it pretty much ended flat. So not much to really note about the day, but the relief rally was pretty weak in terms of the way it came through, at least at this stage. The normal sectors that you expect, all the bash sectors, were the ones that were up, and of course it was a little bit of a switch off from things like utilities and staples, which have been doing incredibly well this year. And it was a risk-on day in general, but again, nothing much to write home about. So let's take a look at where the money is actually flowing. Well, it's certainly not flowing into REITs. The largest outflow ever has just occurred. May 22, we have a huge outflow in REITs, and this occurred also in May of 2020. And it's a symptom of the times, but doesn't necessarily mean that the market is going to continue to go lower or anything. As we can see here, the outflow occurred, but then it came straight back in, and that could certainly occur again. So where is this money going, some people are asking? Well, I think it's pretty simple. At the moment, cash is king, specifically the US dollar. Obviously a hedge against uncertainty. People jump into things like the dollar, and in many ways, 2022 has been shaped by crude and shaped by metals in most places. But there are some other things that might become interesting soon, and one of those is Treasuries, which we'll take a look at later on. If we believe we've potentially started to reach peak inflation, Treasuries in the US 10-year could be actually an interesting trade moving forward, and we'll discuss that later. But where certainly nothing has been good has been world stocks, European stocks, and the general market. That's where all the money's outflowed. It's obvious, we can see it in the charts. Another thing that's occurred is sentiment is really fearful. You'll notice here, here's a sentiment indicator of retail and institutional traders. And what you'll notice here is no one is very bullish. In fact, most people are incredibly fearful right now. Now, in general, buying fear is, of course, a strategy that certain people like Warren Buffett say is good. I mean, he says be, of course, greedy when others are fearful. Well, at certain points, let's say demand points, that may make some sense. And we'll take a look at that a little bit later. We've also made the case here that when we move down on the weekly charts, that's the weekly S&P 500 moves down, it's actually quite rare to go down new lower lows, new lower lows, new lower lows for too long. The market likes to go back to mean reversion. We are now in week 6. So what that means, we're in week 6 of the downward track. That is on average how much the market goes down. And sometime around here, remember, it's quite rare, 2011, 2008, 2004, 2002, we usually hit the low point of the market before having some kind of rebound. It's something we've discussed now for a few days, and I think it brings in a little bit of a different approach to what many YouTubers out there might be saying. Another thing is that bear markets are statistically usually hit around 20%. That is, a technical bear market becomes apparent usually around 20%. So this becomes what we call a defended zone. Usually markets go down to around 20%, And if you look back in history, watch yesterday's video, the previous one we did, and you'll notice that when you go through the S&P 500 over time, when it first hits around 20, 21%, it tends to bounce off that zone, 19.5, 19. You're threading the needle within a few percentage points in terms of a defended zone by the street. And there are many reasons why this occurs, but the big one is because if you get down to 20%, what happens? News articles come out, technical bear market, everything's bad, everything's horrible, we're going into a recession, everything's so bad, and the market then bounces, no one knows what just happened. Part of it is that we are getting to extreme areas. And of course, extreme areas must be counted in the market to allow people to make the wrong decision to potentially enter in, get trapped, similar to, of course, what happened in April period. Let's talk about beats rate. Of course, we're still in earnings. Technically, it's not that bad. 71% beats, 1,288 beats, misses 536. Could be worse. The US economy doesn't look too bad from the current earnings. That doesn't mean the future earnings, but the current earnings. And let's now talk about fear. Is fear reaching a peak? Well, usually I look at the VIX index here, and you'll notice that when it hits around 35, it does tend to be a bit of a resistance point for the VIX. Now, if it blasts through 35 this time, I would probably expect it to jump into a 40 or a 44. And that's going to be met by a big sell-off that usually has algorithms all over it and is pretty brutal. And that's something where some people like to potentially buy what is called capitulation, a very tough trade, and certainly very much around you have to have good risk management. But of course, investors may look at those types of zones. So when we hit the VIX 35, it's certainly an area that some people can look at. Let's move over here to PCC, that is the put call index. What happened in the last 24 hours? Well, it turns out that there was a decent amount of calls re-entered into the market. So people entered a little bit of calls, closed some puts, and it looks like the put call index dropped down here. Still more puts than calls, still above 1. But look at how many puts must be in the system now. We'll check that out a little bit later, but everyone went negative and started placing negative put positions. And many of you would be up in those positions right now. But we'll have a look at where they all are, and then we'll discuss whether they become defended zones by the street. Remember, the street wants to make as much money as possible. One of the ways they can do that is expiring puts worthless and, of course, making a ton of cash for themselves. We call it maximum pain, and that really can be applied to most markets. So I mentioned before that we might be seeing peak inflation. We obviously have a big number coming out in the open tomorrow for the US. We'll talk about that later. But we are down here at a previous point that is basically around the lows of October into November 2018. So this point here is where Treasuries hit a low. And of course, we're seeing that Treasury bonds hitting the same low. A clear point of demand or support in these markets clearly. If we look at the US 10-year, we can see that it's dropped a little bit off resistance. And of course, they're correlated with each other. So this is one of the ways that you can see the market. Now, what you're generally looking for, if you expect, let's say, Treasuries to start to weaken, is a break of the trend. And so far, we really haven't seen that. I mean, the trend is still currently up. But if inflation's going to get broken, it's going to go underneath this level, this last level of demand. And then usually it's going to come back up and then bust down, creating effectively what we call the lightning bolt with all the standard changes of trend that you require. So the US 10-year could be hitting its peak. It actually might start to decline, and that could be again positive for the market. We'll take a look at that soon. But I've said already, I believe in the next 1 to 2 months, we're probably going to hit peak inflation if we haven't already hit so. I have certain indicators that are telling me that. I hope it's true because that would be good for everyone really in the future. The biggest bit of news there is if China ever get rid of their COVID-0 policy, of course, a very bullish bit of news for the markets overall. It really helps the supply kind of situation. Let's move over to the dollar index. We mentioned money's going into cash. Well, what if money starts coming out of cash? What if we see it go underneath, let's say this level over here, and we see it move down from there? Does that mean money is coming out of cash and the DXY is starting to go into a shorting area, meaning that maybe that money is going into risky assets, e.g. the market itself? Well, that would make a lot of sense. And we could be in a distribution here. A lot of people are going to be looking for Wyckoff distributions, etc. in this area. And it makes sense to do so. We're at a point of resistance previously, and we're obviously hovering around that zone. So we'll continue to bring the DXY in as much as possible. Now, strong dollar has meant weakness in gold. And for now, gold is still on a technical short. That is, the market is theoretically shorting each rip. It hasn't had any kind of change of trend at this stage. And if I was looking at the gold market, I'd certainly be focused in around this area here that I've boxed up in terms of, I believe that levels that might come up, there could be shorts in here for day traders, for scalpers, those kind of levels. Certainly an interesting area to look at. If we do end up rallying, there could be shorts there. It's an area of supply, and you can tell that by the dynamics over here. Another thing that we want to be looking at before we actually look at the US 500 is Tesla. Let's take a look at some stocks. Basically, yeah, it's coming down. It's at a point of, previous purchasing. We've seen a lot of purchasing around 800. We know Tesla loves 50s and 100s. So 800 is a bit of a level. There's a bit of a bounce that could happen around 760, 770. And if the market turns to the low that we think may occur, which is around a 38.50, we probably expect Tesla to try to test off that 700 zone. So that is the lows down here. That would be an area of extreme interest for us from a buy the dip style scenario. Of course, you're trying to weave and curve. At this stage, what's this market telling you? Well, it's making a series of new lows. It's currently still in a downward trend. We certainly haven't smashed to an upward trend, and you're just trying to pick bottoms. So that's difficult, but you've got to bring it back. Whenever you have this kind of volatility, it's less so about Tesla and more about the market itself. Has the S&P 500 hit a key level of support? Has the Nasdaq hit a key level of support? That's what you do during times of when the VIX is above 25. It's less about the stock and more about the market composite, so the real index. And you need to start looking at that. Apple creates a long leg doji here. That is a high, a low, an open, and a close. Some people see this as indecision. Obviously, you could also see it as potentially balance between the market. That is, all the orders after all of the fighting for the day sit here. And this becomes a very critical point that we look at in the market. Effectively, there is a level here. Something's happened, the market's paying attention to it. And if it starts bouncing, some people see that as obviously decision made, we're moving higher. It certainly can be, and this is a very critical point now in the market. You can tell why. Upward trend, holding itself as best it can. It busts below. All of a sudden, do we open ourselves to a 140 for Apple? That's something that we'll be asking ourselves. So if we make a new low, it could be very bad here for Apple. Let's move over to the DAX. The DAX held the area we talked about before. That's a demand zone, a support zone. It did bounce up, but now it hits a previous kind of issue area. So again, the DAX is bouncing more than the rest of the market because it's sold off so aggressively, but it will come into areas or zones that could be shorted off. So we're right around there at this stage. Of course, we had that recent swing. It's taken that out, kind of causing a max pain towards the sell side. Anyone that sold with a stop here has been blocked out. And you could imagine that this is a point that over the next 24 hours, the markets will do battle with. So they're going to fight around this zone. There's going to be a lot of fights between the bulls and the bears here. And if the bulls win and get it through, then we move towards the next area, which is going to be around here, etc., on the smaller time frames. Obviously, the big one, the big fight is that downward trend we have on the DAX. So currently, it's still sell the rip in terms of the markets that we're seeing at this stage. IWM pretty much tapped our zone in the last couple of days of trades. Let's have a look at the daily here. You can see it actually tapped into our demand zone and bounced off it. It was pretty brutal for a lot of the hyper stocks. There were some stocks that were down fairly hard on the session and then they recovered back up. There were some that were down another 5, 6, 7%. But we are hitting again a critical zone. This is not only a pre-pandemic area, 28th of Jan 2020, but it's also an area of September 18. So you can see that the market sold off here. There's going to be a lot of orders around this zone, a lot of defense of the market around this zone. It makes sense. This is a big area here for IWM, and it actually tapped it in the last 24 hours. So that could be also showing us that we're getting close to the end of this capitulation, this sell-off for now, before the rally. The Nasdaq moving towards a demand zone. Again, we've got that big area here, previous kind of demand. We've got a support line that goes through there, and we've got a 50 fib underneath. So this is all going to be an area of what you would expect defense in the markets. So what does this all lie around? Well, of course, it lies around a massive psychological 12,000 on the Nasdaq. If we move underneath that 11.8, and of course 12.2. Now we know the Nasdaq loves moving in 200-point increments. It loves it. And if you think about it, how many weeks in a row have we had of decline? 1, 2, 3, 4, 5, and 6. So again, statistically, somewhere around this week is where you expect the market to try to rebalance itself back up. Now, it may want to touch the weekly 20 moving average, the mean reversion, but it certainly will want to try to get back to something like at least the daily 20. Remember, when it moves too far away from the daily 20, it does try to pick itself back up. Think about the previous trends that we've seen. Notice what it's coming back to. Notice what it's coming back to. 20 moving average. If I was to have one indicator on my chart other than volume, that would certainly be the one. Let's move over to the S&P 500. Weakness here, of course, looks horror show on the street. We got here 1, 2, 3, 4, 5, 6. Obviously a big down. 4,000, massive psychological. Where are some of the big previous areas? Well, we've got a lot of zones around here. We've got the doji, lot big orders around there. And of course, you've got that 38, 50, 39 area of previous demand. So this zone makes some sense. Now, it makes more sense than you might think. Let's take a fib of the entire move. Now, some people don't believe in fibs, but really it's more of a psychological kind of pullback. What does this all line up with? A 38.2. As we mentioned in the last video, what else does it line up with? Well, let's take a measurement from top to bottom. It's about 20%. So just above 20% won't trigger a technical bear market, but it becomes that kind of average that markets like to come back down to. So if we sell off, where do we expect some defense to occur? Around that 385, 390 zone on the SPY. And this area is critical to this market. So that's something we're certainly looking at. But let's now just quickly get rid of all these lines here for a second and also consider something else. Because of course, there's a lot of different methods that people use in these markets. So if we consider the pull down of this move, and then we consider where it's at right now. Well, one second, I made stuff up there. Take it down to the low. And there we go. What is that doing? Well, it's telling us that we're getting damn close to the general move of the previous move that then pulled up and then it sold off. What if we consider this as a leg? Of course, some people will see this as certain theories. I do believe the market moves in legs, and of course it does make sense. So if this is a leg, did it just go down enough to allow it to then pull back? And then does the question bit differ? Well, do we pull back this much? So let's say we pulled off a new low. Let's say we go and hit kind of this area. Where do we then expect it to come back to? And you might say, well, I don't expect that. I expect it to come back here and sell off. Well, yeah, a lot of people didn't expect it to go this high either. So the market is tending to trap people. And of course, unfortunately, you won't really know you're fully out of some kind of bear market until it kind of snaps something like this. Let's say it does this, snaps that high, and then snaps through here. That's going to be when everyone starts piling back in heavily in terms of the biggest funds. But there'll be lots of opportunities through here. So these are some of the ways that you think about markets, and hopefully it makes some sense. And if you enjoy this stuff, please subscribe. It does help us out. But yeah, that's the way we look at it. So we mentioned that it's currently still a sell the rip market. Well, it certainly was in the last 24 hours. We had this box structure. Obviously, this is a zone that we believe the market would sell off. It did sell off. It went to a new low. If you're scalping, of course, you don't try to predict too much past what you already know. So this becomes a level where you would descale your position. And yeah, makes a lot of sense. Of course, there's a supply area. Now, if we're thinking about it, we've got a new low that's formed here. All right, so could that be max pain? That is, a market has gone to a new low, trapping sellers in, and then rallies through. Well, we don't really know whether the market wants to go higher at this stage. At this stage, it hasn't even breached past this level, which we already know is a big shorting kind of level. People are going to try shorting that zone. So if we move back up and then we breach through this area and we breach through this zone, and then we pull back, I think there will be potentially buyers around here. And then they'll try to push it through. And once we get this, we've got that lightning bolt up. So of course that becomes a more likely scenario. We are now currently moving towards something like the daily 20, etc., etc., etc. on the markets. But this is effectively a point of interest. So somewhere up here is a point of interest. And for now, it's still harder to buy than it is to short from a scalping day trading perspective. From a perspective of investment, you've always got to look at it. Well, how close am I to my main target? And you're getting close towards the percentages. So down here, you're getting within 2.5% kind of those levels. So you've got to say, okay, well, what am I doing next? You've got to have a plan around that. Of course, it's important. Let's move over to maximum pain. As we mentioned, we probably expected maximum pain to come down. It is. Each day it drops. This is the maximum pain for this Friday. So that is if all options expire worthless. The best level for the market to be resting at come Friday would be 413. So that's 413 on the SPY. What you'll notice is a lot of closures of puts around the 400s and a huge amount of increases around 390, 380s, 380, even 365. People are going super bearish here in the week. Possibly a big mistake. I mean, look look how many people have gone bearish in the last 24 hours. Compare that to the video we did previously. My goodness, it's huge. Let's move over to Bitcoin. Bitcoin entering a level of demand. You know, if fortune favors the brave, sure. If you like the crypto market, I could think of worse levels than right here to have a go at it. But yeah, it's going to be difficult for you to say that unequivocally this is a buy zone. Basically, crypto is losing steam because it's losing the amount of euphoria in it. When the crypto market really needs retail traders, that is, it needs retail injections and people to believe they can make money off it. So right now, people have a very negative approach to it. And of course, that could be the time. But do remember things like what we've talked about recently, the crypto winters that occur. So this market could be connected to the rest of the markets. Right now, of course, it's risk off. So that's why it is. If risk on comes back to the Nasdaq, I would expect crypto to do better. But we are in a level that if you break it down to smaller time frames, there might be some buying opportunities, some accumulation, possibly something else going on. Bitcoin shorts is coming down. I guess that is a slight positive. It does show that maybe some of the short positions are mitigating themselves, getting rid of it. And they're saying, okay, well, it's time for us now to get out of the shorts and to potentially move towards the bull side. So that's certainly a positive. If you haven't already, please do follow us at FX Evolution on Twitter. That does help us out. Come join us. We do share stuff there all the time. Come and join us in the Discord, the public community. Obviously, if you want to join the privates, you can do so by clicking the link in the description below and going to that 7-day free trial. And overall, we have some massive news. I mean, we got CPI coming out 8:30 a.m., so 1 hour before the market opens, New York time. I expect fireworks throughout here. Could be some huge levels hit. And then, of course, rejected. We'll see what happens. And then we've got PPI on Thursday as well. So the US has some news coming out. We're going to find out a lot about what the economy is doing, what's happening in the world. And this will shape, no doubt, the next couple of days of trade. Thanks so much for watching. If you enjoyed the video, why not consider subscribing? Smash that like button, guys. Thank you very much. We'll see you in the next day.